Meta Platforms just reported their Q4 results, and as the conference call is underway now, we're seeing shares move up higher by nearly 5% in the after hours. We'll put into context these Q4 results for you, and spoiler alert, they're absolutely stellar. This company comes yet again with a blowout quarter. Now we'll also take a look at the guidance for the current Q1 we're in. That came in a little bit lighter than what Wall Street was anticipating. We'll put those into context for you, and then we'll of course walk through all of the important financial metrics. And when we get to the technicals, you'll see this one is making a beeline higher, at least at the current time. We do have the conference call underway, so you could see shares whipsaw around a little bit based on what Mark Zuckerberg is saying on the conference call, but we'll take a look at it from a technical perspective. You certainly don't want to miss that. Hey guys, hope you're doing well out there. We're in the thick of earnings season and kicking things off like we always do with Meta Platforms. A fantastic time to be a shareholder of Meta Platforms, as over the past 1 year, you're up nearly 67, close to 68%, and you're extending those gains in the after hours, and a lot of that is for the right reasons. Now, one thing to remember is this company began paying out a dividend, I believe, at the start of last year, and you're getting a very small forward yield on this, but I anticipate that to continue to move up over the subsequent quarters. Now, the all-important Q4 revenues came in at $48.4 billion. That was good for 21% growth year over year. That is spectacular growth. Also keep in mind, this was the holiday time period. This was Meta's Q4, where advertising budgets tend to be a little less looser, and so you have a lot of people sort of throwing money on the wall when it comes to advertising on Facebook and Instagram, and so it tends to be their largest quarter. Now that came in with a huge $1.4 billion beat, because the estimate on Wall Street was closer to $47 billion. In fact, the most bullish analyst on Wall Street had a figure underneath $48 billion. And Meta posting a revenue figure north of close to $48.4 billion. You also got a huge beat on the bottom line, as earnings came in at $8 a share. The expectations were significantly lower, I believe closer to $6.74. So yeah, a huge beat on the earnings side as well. Now keep in mind, some of the earnings benefits is due to certain non-recurring benefits on the G&A side. We'll take a look at that when we get to the statement of income. Now, the more important thing though is the outlook for the current quarter we're in. So in the first quarter of 2025, total revenue guidance expected to be in the range of 39.5, call it up to $41.5 billion. So you take a midpoint of $40.5 billion, and yeah, that comes in a bit underneath what Wall Street was anticipating, which was closer to $41.5 billion. But look, Meta has certainly learned to play the game of Wall Street, and I certainly anticipate they come in with a slight sandbag of a guidance figure slightly underneath what Wall Street is anticipating. And then 3 months from now, we'll be sitting here taking a look at Meta's Q1 report that will likely come in with a huge revenue beat, also probably with a huge earnings beat as well. But their current guidance of roughly $40.5 billion on the revenue figure accounts for roughly 8 to 15% year over year growth. And when you account for constant currency, you're anticipating nearly 11 to 18% growth year over year. So you're seeing that sequential slowdown, but keep in mind, again, you're going from Q4 to Q1, and so naturally your Q1 revenues will be a bit lower, especially considering the fact that you're lapping that hyper growth Q1 we experienced early in 2024. Now, they also did say that full year 2025 total expenses are expected to be in the range of $114 to $119 billion. So jumping ahead just a little bit, we want to see what their full year costs and expenses were for 2024. And we see that was close to $95 billion. And in fact, last year it was at $88 billion. So you're going from 88 up to 95. And now Meta is telling you they're expecting roughly $115 billion, you can call it, in terms of total costs and expenses. So you're going up by roughly $20 billion on your full year costs and expenses. They do say the single largest driver of expense growth is expected to be infrastructure costs, driven by higher operating expenses along with depreciation. And then they say the second most important increase in expenses is due to the fact that they're planning to hire technical talent in the priority areas of infrastructure, monetization, reality labs, and of course, Gen AI. So you have a few things. You have, first of all, of course, the higher CapEx building out your infrastructure. We'll take a look at that when we get to the statement of cash flows. You'll see the CapEx over at this company continues to just balloon. The other important thing is this company is once again hiring and once again growing their employee base, especially more so in the technical side of things, and focusing on the priority areas of infrastructure and Gen AI. Now, as we talked about, the CapEx is very important over at Meta. We got this figure, I believe, a couple of weeks ago, where Mark Zuckerberg announced that capex for the full year expected to be roughly 60 up to $65 billion. That is a pretty significant increase from 2024. In fact, I believe full year of 2024, they had roughly $40 billion of capex. You're anticipating nearly 50% growth on your capex for the full year. And keep in mind, a lot of that is due to the fact that you're continuing to spend excessively on those NVIDIA GPUs, trying to build out your infrastructure, trying to at least maintain the lead. And well, at least for Meta, they absolutely do have a use case for it, considering how popular their family of apps are. Now, speaking of family of apps, the family daily active people, which is basically the number of people on a day-to-day basis using at least Facebook, Instagram, Messenger, or WhatsApp, continues to just tick higher. Really, when you think that the growth has stalled out in terms of number of people using one of their platforms on a day-to-day basis, it just continues to move higher, now sitting at 3.35 billion. That's right, that's in billions of daily active people, continuing to grow year over year. You're actually seeing an acceleration from quarter ago, and just one of a very, very strong number this company continues to put out. The other important metric you have is the family average revenue per person, or the average revenue per user. That also continues to tick up in line, now at $14.25. They also did mention they're continuing to see growth on their ad impressions, also on the average price of the ad, especially as the algorithm over at Instagram and Facebook continues to get better as Reels monetization really takes into helm. And then obviously, if you have a slowdown in TikTok usage, that can absolutely help ad impressions, also help drive up the average price on those ads that you see over on Instagram. Now, on the different segments, of course, we have to take a look at the advertising business, which remains the bread and butter, remains why this company continues to outperform, why the shares are up nearly 70%, why you're also seeing shares up 5% in the after hours, because advertising continues to hum along. You went now at $47 billion in terms of Q4 advertising revenues. In the same time last year, you were closer to $38.7 billion. So you added on, call it around $8 billion on your advertising revenue side. Now, what's even more impressive though is how well they're controlling costs on that business. As last year, you had operating income of roughly $21 billion. Now that's ballooned up close to $28 billion. So you added close to $8 billion on your top line on the advertising side. But what I want to highlight is you added nearly $7 billion of that on your operating income side. Guys, if that doesn't tell you that the operating leverage is kicking in over at Meta, I simply don't know what will. Because look, if you add $8 billion on your top line and $7 billion flows down to your operating income, that is just absolutely juicy margins. That is what you hope for. That's what you dream for when you start scaling out a social media business. Now, on the flip side though, you do have some things that don't nearly look as pretty. And of course, with all things in life, you have some good with some bad, and that comes in the Reality Labs segment, as you did see an uptick in your Reality Labs revenue, basically 1% higher year over year. But what I want to highlight is you continue to bleed more and more money on an operating basis in the Reality Labs segment. I've said it time and time again. Really, every time we come in here, look at Meta's earnings, Reality Labs needs a reality check. You can't be burning $5 billion of operating loss every single quarter. I mean, just you add up the losses on the Reality Labs segment, and it's tough to swallow as an investor, because look, if you didn't have this segment, if you get to add back nearly $5 billion of this operating loss onto your total operating income, I mean, your margins would be sky high. It'd be close to 60, if not 70% operating margins on this business. And so what Meta is doing over at Reality Labs certainly over the long term better play out, because if it doesn't, then you'll have a lot of investors just hoping and dreaming that this cash burn that they're currently seeing on this Reality Labs segment, well, eventually it should have stopped. But like we always also point out, that while the advertising business remains strong, while they continue to still focus on monetization here, the losses on the Reality Labs segment, we can sort of turn a blind eye towards, at least for the current time. But again, it's just tough to see every time we take a look at Meta's earnings, the burn on the Reality Labs segment continues to sting just a little bit more. Now, Meta did consider testing DeepSeek's Gen AI tools meant for advertisers. So by now you've probably heard many different takes as it pertains to DeepSeek's R1 Gen AI model. Certainly you have experts saying that it's tough to build out what they did in under $6 million. You also have them saying that they do have access to a number of NVIDIA's high-end GPUs. And of course, that $6 million cost that is getting thrown around, of course, does not include the R&D that DeepSeek did use to train their model. But of course, the still important thing to note is that the R1 model did perform really, really well, especially compared to OpenAI's model, Claude's model, of course, as well compared to Llama. And so Meta is considering testing DeepSeek because of its, quote, high performance. And they continue to regularly work to understand all the available models out there and see where they can fit those into their business. You also have some advertisers complaining about the accuracy of the text and image generation tools provided by Meta's own Llama models themselves. So really what I think this will do is, first of all, it's a welcoming sign for the Gen AI community. I think anytime you can have more models come in that perform just as well, that are cheaper, it increases the competition, it increases the drive to continue to improve your models, continue to lower costs, and find ways to be better. The other thing it does is it really validates Meta's and Llama's approach towards going open source. So we know DeepSeek's R1 model is certainly open source, and so is Meta's Llama model. And I think anytime you have open source models continuing to perform just as well as closed source models out there like ChatGPT, I think that's validating the open source approach that Meta is taking. And certainly what I think they'll do is they'll go in here, take a look at DeepSeek's R1 model, see where they performed really well, see how they can tweak their own Llama models to continue to perform better, and then again plug those into their applications, because Meta is one of those companies that is certainly benefiting from the use of those AI algorithms in their own applications. Now, you did have Meta CTO say that Reality Labs did beat 2024 sales targets along with user targets. We just took a look at Reality Labs segment in terms of how much it's bleeding money. And so sure, the CTO can go out there, say they're meeting their sales targets, they're meeting top line targets. It's really, you want him to talk about the bottom line, because Reality Labs continues to just burn through money. The hope is over at Meta, they have a clear picture towards profitability on that business, and they have a vision where the Reality Labs segment begins to take off, especially from an earnings side. Now, speaking of earnings, we have a fantastic P&L report here from Meta, $48.5 billion in top line revenues. Your costs and expenses didn't expand nearly as much as your cost of revenues went from 7.7, call it up to $8.8 billion. You did tick up roughly 20% on your R&D. This is something I actually do like to see with these tech companies continuing to invest in R&D. I think that's how they get their separation from other companies. Hiring the best talent, hiring the best engineers certainly isn't cheap, but that's how you get results like these. On your marketing and sales side, that's staying relatively flat. That is impressive to see over at Meta, despite a Q4 where they try to push out a lot of marketing and sales, especially for the Meta Quest and the Reality Labs products. The important thing to note though is on your G&A side, you had those expenses take down, but keep in mind you have this one footnote here, and they did say the fourth quarter includes an impact of favorable expenses due to roughly $1.5 billion in terms of decrease in the accrued losses for certain legal proceedings. So certainly it's not a recurring expense, but even if you add $1.5 billion back onto your G&A line, you get to roughly $2.2 billion, which would be flat year over year. And that is a win we will take, because look, you're growing your top line revenues, you're keeping your G&A costs flat. And in fact, over the last year, you're keeping them lower on a year over year basis. That is impressive to see. And so for your income from operations went from 16 billion, call it up to $23.5 billion. That is impressive. You also saw a huge uptick on your earnings per share, especially on a full year basis, considering the fact that you're also taking some shares off the market due to that buyback. Now, from a balance sheet, you have a very impressive balance sheet over at Meta at this point, nearly call it $75 billion in cash along with marketable securities. That is up, call it meaningfully year over year. And then you come down to the property and equipment line, and this is where you see the bulk of the additions on their asset side, as you're going from roughly $96 billion up to $121 billion on your property and equipment. This is where all that capex into different infrastructure and data centers and GPUs, this lands right here on your balance sheet. Now, in terms of liabilities, you did see an uptick in your long-term debt year over year, but nothing to be overly concerned about. Just $28 billion in long-term debt, well underneath what they have sitting on their balance sheet just in terms of cash. Now, from a cash flow perspective, you got $28 billion in operating cash flows. That is up meaningfully from same time last year, where you were closer to $20 billion in operating cash flows. But what I want to point out is the capex over at this company continues to expand. You nearly doubled, in fact, your capex year over year. Last year, you were closer to $7.5 billion of capex. now you're closer to $14.5 billion in a quarter in capex. So despite higher operating cash flows, your free cash flow actually relatively muted in terms of year-over-year growth, simply because of how fast you are growing your capex. And like we saw, this company is guiding for full year 2025 capex to be roughly $60 to $65 billion. They just did $38 billion in full year capex for 2024. So expect that capex to continue to increase meaningfully year over year. And while they continue to increase those operating cash flows, your free cash flow over at Meta will probably stay relatively muted from a growth perspective over the next 1 year. But look, despite that, they still have plenty of operating and plenty of free cash flow really to continue to pay out that dividend, in my opinion, probably bump it up. And they did pause on that buyback in the most recent quarter, but keep in mind, for the full year, they did still buy back nearly $30 billion worth of the stock. And so it looks like they were buying back most of their stock earlier on in the year, where shares were probably closer to $400, if not lower. And as shares are now trading near $700 in the after hours, yeah, you see there's a reason why they stopped on that buyback, at least in the most recent quarter. Now, speaking of the technicals, you have the stock continuing to just power higher, trading north of $700 in the after hours. Now, I have this uptrend marked out, which is pretty textbook. You basically are making a very consistent pattern of higher highs and higher lows. You're once again testing the top end of the range. So at this point, I wouldn't be surprised if you see a sort of rejection here, see a retracement back down to at least this level of support in the 630s. That would be a pretty sizable pullback. And look, anytime you get pullbacks in this name within this range, I think that is your time to buy shares of Meta, as you're seeing the fundamentals are absolutely intact. Now, one thing you could get is, because you're breaking through this upper support, is maybe there's a lack of gravity and shares continue to power higher, and you could push up highs maybe as high as $720, $730. But keep in mind, shares have already rallied pretty significantly, and so I would expect pullbacks in shares of Meta. And so if you aren't in this name at this point, wouldn't be overly excited to chase shares at this point. Wait for the pullback, be patient. We talked about that when we took a look at Netflix's earnings. You're absolutely going to get pullbacks in these names at one point or another, and that is when you pull the trigger and begin to build your position, or simply just add shares if you've held this one over any length of time. Now, with the conference call currently going on, it's important to take a listen into what Mark Zuckerberg says, and I'll certainly be doing that later tonight, but we simply have too many earnings to get to today. Been waiting on Microsoft and Tesla as well, so stay tuned here on the channel. We'll be sure to cover those for you as well. That was my take on shares of Meta Platforms. A fantastic quarter for a fantastic company, really what you would expect. They continue to blow out results. They came in a bit lighter in terms of guidance, but I would anticipate them to come in with a beat yet again next quarter. Let me know your thoughts on this one in the comment section below. Congrats to all holding shares of Meta. I'll catch you guys in the next video.